When you look at the real economy, not the stock market, not corporate profits, you get a completely different sense of what's happening. There are pockets, there will always be bright spots even in the darkest times. Today, however, we are seeing so many negative aspects and the cause is still not understood by the majority. The 2008 financial crisis was never resolved. It was a shot of adrenaline, and now that stimulation is wearing off and reality is sinking in. You came here for the truth, so let me unveil that for you. Today we are going to look at what's happening in the real economy. I want to show you that, but I want to give you an idea of what's happening in the stock market today and show you how disconnected we are from reality. These are the major US exchanges. You're looking at the NASDAQ, the S&P, the Russell, and the Dow Jones. All of them have made it above their 50-day moving averages. This is positive for stocks. You have seen them rising pretty much every single day since Christmas. This has shown the strength of the US stock market. But that's not the real economy. What we are seeing with the economy is completely different. And there are several indicators you can use to measure the current state of the economy. But I want to take it on a different approach. I want to look at some unconventional methods that can't be quantified into what you're seeing on a 50-day moving average, on a 200-day moving average. You need to look at other details and be able to piece the puzzle together. Now, I have some information here that goes along with this, but take a look at this article out of Bloomberg. U.S. home sales plunged. Price growth at the 6-year low. Sales declined by 11% in December as prices rose just 1.2%. This is one area. If you take it on certain cities, a different level here, you start to be able to understand what has happened. The areas in which saw the most appreciation are now seeing the biggest troubles. They are dealing with a major issue because a lot of hot money starts flooding in, and then those people who got in right at the end are immediately screwed. That's what's happening in areas like Seattle. You're seeing it in Las Vegas, of course. There are a few other cities that I've shown you where the price increased so dramatically right up until the end, and then suddenly it was a disaster. Now, there's a lot to this, okay? So that's the investor side of it. But what about the individuals who just needed to buy a home because they wanted to live into it, and they are finding the same problem with stocks? They are basically having to fight against a system that doesn't have their best interest at heart. The individual who's paying $1 million for their home, this is not good for them. When stocks are rising so considerably over the last few years, that's not good for the average person. It doesn't allow them an opportunity to get in, to start accumulating. They are not able to do this, and that's because of the financialization of all of these different assets. Your average home in the average city should not be unaffordable to the majority of the people who live there. That doesn't make sense. You know you have a problem when you're seeing this occur, and it's happening for the most part in every major city. Whether we're looking at Canadian cities like Vancouver and Toronto, yes, they've slowed down, but the prices are still way too high comparing the average salary or the average household income. You can look at what's happening in other areas like New York, San Francisco. You're looking at any of the major population centers where most people live. Their wages and their house prices don't add up. It's the same exact thing with stocks. They went up so fast, it doesn't give people an opportunity to get in over, let's say, a 30-year period, like most people would have a 401k or retirement account. Things become too expensive, and then you have a bust. And when that bust happens, people really get screwed over. And they just say, invest for the long term. But that's not really what people want. They want a select amount of return over a period of time. If they could guarantee you, let's say 5% or 7% every year in a mixed portfolio, you got some bonds, you got some stocks, you got all different types of things, and then it would give you, let's say 5 or 7% every single year. That would be fantastic. But instead, some years you're getting 10%. And then the next year, you're minus 10%, and then you're up 20%, and then you're down 10%. This is a wild ride, especially when you look at an average individual who doesn't want to do any of this. They just want to buy a home. They just want to buy their 401k that they put in on their monthly input or on their paycheck or whatever they have. So I hope that I've made this introduction, although long-winded, it's very important for what I want to show you today. I hope I've made that very clear. This is the chart associated with that, but I really wanted to cover this next point. The stock market made its way into mainstream use in 2018 when it hit record highs and then subsequently tumbled 19% in a matter of weeks. Market volatility is unsettling to investors, but just who makes up the investor class? According to Goldman Sachs, stock ownership is extremely concentrated because of the growing wealth gap in the US, and thus the market's performance affects households making up the wealthiest 1% of Americans much more significantly than the other 99%. The wealthiest 0.1 and 1% of households now own about 17% and 50% of the total household equities, respectively. That number has obviously increased over the years. This is a chart that basically tells us that same information. You can see it here for yourself. And you always hear me joking about the 7 shares of Amazon, and this is basically my strange way of mentioning this data. I always talk about the 7 shares of Amazon, and basically this is what it is. The average individual doesn't own any stock compared to what the richest individuals do. They are the ones who control everything, and the higher up the food chain you go, the more they control. If you look at the top 5%, yes, they have more wealth than the bottom 95%, but comparing the top 5% to the top 1%, there's a huge difference. And then you look at the 0.001% compared to the top 1%, it's even vastly different. So we can see that happening not just with stocks, but with assets in general. Certain assets today, as we speak in 2019, are heavily undervalued. Others have been overvalued. You can see this measurement based on where they were a select number of years ago, where they are today. You can see how much money is invested into this. You can see the future prospects. There's a lot of different indicators here. Some individuals look at how undervalued the asset currently is. One investor is the billionaire Sam Zell. You may have heard of him before. Gold's dimming supply prospects have caught the eye of one billionaire. For the first time in my life, I bought gold because it is a good hedge. Supply is shrinking, and that is going to have a positive impact on the price. Now, he's made that prediction. I'm not saying that. In general, when we have inflationary times, precious metals have been good. In fact, real assets have been good, but particularly with precious metals. I don't know what's going to happen in the future. I cannot tell you that. That information is going to be provided to you by the financial experts. So you have to go and find people that call themselves financial experts. They know everything. I don't. But Sam Zell, the billionaire, has suggested this is good. The amount of capital being put into new gold mines is most non-existent. All the money is being used to buy up rivals. So this is a good way to look at the data in a different way. He's not necessarily saying today the price is this, so tomorrow therefore the price has to be this. Those are predictions. Those are trying to justify the price that you've set in your mind, which I don't agree with any asset. A lot of people have said, look, in 2009, let's say, the price of the Amazon stock was this, today it's this, and therefore it's going to continue to grow. That doesn't make any sense at all. You cannot justify the purchase of something today because of the price it was at yesterday. That is a very, very failed way of looking at things, and people get burned all the time because of that, particularly at the peak. Now, this is Sam Zell. That's just one individual. I don't necessarily believe that you should do what other people do and chase what they do simply because they're a billionaire, so they must know. A lot of people do this with Warren Buffett. They see whatever he buys, they buy it. And that is not a good way to invest. There's a whole different strategy that you should be following, but that's none of my business. I'm just showing you what's happening today. A lot of people are wondering, what do I buy? So you have to look into it for yourself. You have to figure that out. All I know is that what we're dealing with today is unique because quantitative easing has sloshed around $15 trillion worth, plus all the secret donations that the Federal Reserve gave. But when we look at this, all of the effects of all this quantitative easing, whether it's come from the ECB, the Fed, the BOJ, the PBOC, and so on, all of that has made its way generally into stocks. It's made its way into equities. Those are the two obvious and the primary ones that we look at. But none of it has made its way into precious metals. And this is so strange. You would think at least somewhat. We have seen the most massive monetary easing that these central banks have ever done, and yet none of it made its way into gold and silver. It's extremely strange. I'm not saying that they should be worth any more than they are today. I don't know what the actual price of gold or silver should be at. But if we're going to destroy the value of the currency, then that makes everything rise in a nominal fashion. That's the way we see it. But it didn't happen with gold and silver. And then, of course, if you look into it deeper, you find out what's really happening with gold and silver. It's heavily manipulated, both of these in the exchanges. You look at physical metals, which have obviously always been in demand. There's always some level of demand for jewelry, especially when you see that. Of course, silver more with technology. And look at the central banks. They're continuously purchasing. This is just the evidence that we have to show you what has happened. Now, you can look into the details, the miners and all that data that's out there. But I just wanted to point to a different type of information, looking at this from a different level. What is very interesting is that palladium has been absolutely dominant right now. We're looking at January on this chart here, and it has just skyrocketed, and you could see it comparison to gold right now. It's at the highest level it's been since 2002. So this has really rocketed higher, as you can see here, in relation to gold and also its own price. That's something very interesting because a lot of people, myself included, we tend to focus on gold and silver, but there's platinum and palladium as well that does deserve some attention. People need to be focusing on it. Even if you're not going to buy it, you should still be focusing on the information of precious metals because they have sort of a way of telling us a story about what's coming, and that's a good indicator for a lot of people. It's just one more indicator on top of the hundreds and hundreds we should be looking at on a regular basis. So I just wanted to show that information to you and then get to my final point for today. The real economy is suffering, and this is one very good way to look at it. Yes, it is an unusual way to look at things, but the crisis of poverty is spreading rapidly, and that's what I like to look on my own to be able to determine what's really happening. We can look on the streets of our cities and see what's actually occurring. In Toronto, for example, there are people sleeping on the streets in every little nook and cranny. I've seen people sleeping in a crevice in a little bridge that's above the water. I've seen people underneath the bridges in different areas that are kind of secluded in a way. For those in Toronto or no Toronto, the Gardiner Expressway, one example there. If you look around, you're going to see these people starting these encampments, and this is in cold environments that have harsh winters. Of course, if you're in LA, it becomes much more easy to do so. But regardless, in every city, you're going to see people that are in poverty, and the problem is getting much worse as the months go on. It's not as if, hey, look, if I see the statistics 20 years ago, 30 years ago, there's always people sleeping on the streets. That's silly to make that argument. I've seen that argument before, but it's getting worse. No matter where you turn, it's getting worse. And that's because of what central bankers do. They print money and they put it in the pockets of the most rich individuals. Then we have that trickle effect, and it affects the people at the second tier a little bit more, and then as you go down the tiers, it's less and less and less, and then the people at the bottom ultimately get the worst of it. They're actually getting it taken away from them as a result. This is just basically some proposed housing projects, but I just wanted to show you the real deal. When I look at the economy, I'm not looking at the S&P 500. When I talk about global economic collapse, there's this confusion that they're saying, but the stock market's up. If you somehow correlate the economy with the stock market, we're not on the same page, and I think that it's really confusing for a lot of people because they probably don't know anything about the stock market or anything about the economy, but they do have their 7 shares of of Amazon. And as you know, they're always right. If you found this video informative, then please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. All you gotta do is click one button to support me. If you want the financial education that was not taught to you in school, that's more in depth, that gets into everything all the way back from the foundation, the history and everything else, then check out my books in the link in the description if you want the audiobook. That's at themoneygps.com.